Hey friends, very good morning. Welcome to another most interesting video of FxYogi. In today's video, we will explain about margin call. Assume you are a successful retired British spy who now spends his time trading currencies. You open a mini account and deposit $10,000. When you first log in, you will see the $10,000 in the equity column of your account information window. Usable margin. You will also see that the used margin is $0 and that the usable margin is $10,000 as pictured. Your usable margin will always be equal to equity less used margin. Usable margin equals equity minus used margin. Therefore, it is the equity, not the balance, that is used to determine usable margin. Your equity will also determine if and when a margin call is reached. As long as your equity is greater than your used margin, you will not have a margin call. Equity greater than used margin equals no margin call. As soon as your equity equals or falls below your used margin, you will receive a margin call. If your equity is equal to or less than the used margin, then you will have a margin call. Go back to demo trading. Let's assume your margin requirement is 1%. You buy one lot of Euro USD. Your equity remains $10,000. Used margin is now $100 because the margin required in a mini account is $100 per lot. The usable margin is now $9,900. If you were to close out that one lot of Euro USD by selling it back at the same price at which you bought it, your use margin would go back to $0 and your usable margin would go back to $10,000. Your equity would remain unchanged at 10,000. But instead of closing the one lot, you got extremely confident and bought 79 more lots of Euro USD for a total of 80 lots of Euro USD because that's just how you roll. You will still have the same equity, but your used margin will be $8,000, 80 lots of $100 margin per lot, and your usable margin will now only be $2,000 as shown. With this insanely risky position on, you will make a ridiculously large profit if Euro USD rises. But this example does not end with such a fairy tale. Let us paint a horrific picture of a margin call that occurs when Euro USD falls. Euro USD starts to fall. You are long 80 lots, so you will see your equity fall along with it. Your used margin will remain at $8,000. Once your equity drops below $8,000, you will have a margin call. This means that some or all of your 80 lot positions will immediately be closed at the current market price. Assuming you bought all 80 lots at the same price, a margin call will trigger if your trade moves 25 pips against you. 25 pips. Euro USD can move that much in its sleep. How did we come up with 25 pips? Well, each pip in a mini lot is worth $1 and you have a position open consisting of 80 freaking mini lots. So, $1 per pip into 80 lots equals $80 per pip. If Euro USD goes up 1 pip, your equity increases by $80. If Euro USD goes down by 1 pip, your equity decreases by $80. $2,000 usable margin divided by $80 per pip equals 25 pips. Let's say you bought 80 lots of Euro USD at $1.2000. This is how your account will look if Euro USD drops to $1.1975 or minus 25 pips. As you can see, your usable margin is now at $0 and you will receive a margin call. Of course, you are a veteran international spy and you have faced much bigger calamities. You have got ice in your veins and your heart rate is still 55 BPM. After the margin call, this is how your account will look. Euro USD moves 25 pips or less than 22%. 1.2000 minus 1.1975 divided by 1.2000 into 100%, and you lose $2,000. You blew 20% of your trading account. $2,000 loss divided by $10,000 balance into 100%. In reality, it's normal for Euro USD to move 25 pips in a couple of seconds during a major economic data release, and definitely that much within a trading day. Oh, we almost forgot we didn't even factor in the spread. To simplify the example, we didn't even factor in the spread. But we will now make this example super realistic. Let's say the spread for Euro USD is 3 pips. This means that Euro USD really only has to move 22 pips, not 25 pips before a margin call. Imagine losing $2,000 in 5 seconds. This is what would happen if you don't understand the mechanics of margin and how to use leverage. The sad fact is that most new traders don't even open a mini account with $10,000 because you had at least $10,000. You were at least able to weather 25 pips before his margin call. If you only started off with $9,000, you would have only been able to weather a 10 pip drop, including spread, before receiving a margin call. 10 pips. That's all for today. Let's catch up in the next video with more interesting content. Until then, take care. Bye-bye.